Welcome to our place, BNZ. I'm Mark Watts, Head of Corporate Affairs at BNZ. Thanks for coming along tonight on a fairly inclement night. Can't do much about the weather. Welcome to DAS and our friends from the New Zealand Initiative. Before I hand over to Ken Christie, our Chief Financial Officer, just a couple of housekeeping matters. The toilets are just off to the right from this room, and if in the unlikely event there's a fire drill or a fire emergency, the fire exit is marked by an exit sign also about halfway between here and where we've been before this, and there's stairs from there, so if the fire alarm does go, make your way to the exit sign, go down the stairs please, and assemble in Jean Batten Place, where we'll all get extremely wet tonight, I think. But yeah, welcome again. I'd like to hand over to Ken Christie in a minute. The presentation will run for an hour or so, and there will be time for a few questions and answers after that, and you're welcome to stay for another drink or two and some conviviality after that. Thank you.
Thanks, Mark. I appreciate that. And for those who don't know me, I am the Chief Financial Officer of the bank, and welcome to everybody tonight, and I appreciate you coming out, like Mark said, on a pretty challenging evening. This initiative is hosted by the New Zealand Initiative and the BNZ, and it's certainly my pleasure to invite you here to the BNZ, and this is one of our partner centres, of which we have 31 scattered throughout the country. I'd like to have a warm welcome to Das, who's come back now several times to New Zealand, and it's great to have you back here. I also want to like to welcome Dr. Oliver Hartwich, who's the Executive Director of the New Zealand Institute, the executive team from BNZ, as well as some staff members and representatives from a number of New Zealand businesses. I'd just like to convey that Andrew Thorburn couldn't attend tonight. He's also a director of the New Zealand Initiative. He had to go to Australia for a group executive meeting. They've got planning and budgeting going on over the next 2 days, so he had to be there because our plan's being set tomorrow, so it was important that he actually attended that meeting as well. We've got a huge hour ahead of us, and Dash will be able to share with us some really deep insights from what he's experienced around the world that will affect all of our businesses. You know, we're really proud as a company in New Zealand to try and have the best people we can have to talk to some of our great clients and talk to some of our executive and share their insights. So this is a classic example of us sharing that. I think the New Zealand Initiative really has a clear vision around where New Zealand Inc. as a country should go, and we're helping support that broad discussion that's critical for some of the challenges we face ahead. As many of you know, Dash is a very influential person in the financial system, has written a number of books and has a number of strong views. I think it's really important that we have thought leaders like him visit New Zealand on a regular basis so we can get an outside perspective of what's happening in Europe as well as the USA. I have watched recently a couple of interviews that was given this morning and a couple of other film clips. We're very much of the same viewpoint of some of the challenges that are happening in Europe and the US, and my wife's a born and bred New Yorker, and I have lots of discussions with her about the challenges in the United States, let alone the fact that they've got $15 trillion worth of debt, which is going up at $3.9 billion a day. Their interest alone is $1 billion a day. And as I say to my wife, that pales to insignificance to the $52 trillion of unfunded liabilities you have for social security for the future, Medicare and Medicaid. So, you know, people talk about the challenges around Europe and some of the issues. I think the US has some deep-seated issues which really haven't come to the forefront yet. So we're very fortunate to be in this part of the world with economies that are still growing and debt positions in reasonable shape relative to global peers. We're about to enter our 151st year of being a bank in New Zealand, and we're in good shape, and we've really been working hard, you know, to drive the right level of capitals to be a strong, sustainable bank. There's fortunately only 7 AA rated financial institutions in the world, and we're fortunate to be one of those. There are over 25,000 financial institutions and intermediaries in the world, and only 7 are rated AA, 7 are rated AA or higher. We're fortunately one of those. But I can't say that we haven't had our trials and tribulations over 151 years. We've gone through some ups and downs as a bank, as many of you would know. But, you know, we're really preparing ourselves for Basel III and the capital requirements and the liquidity requirements, and the Reserve Bank has really been in an accelerated mode on that over the last few years. One of the other interesting facts that we were there to support businesses through the global financial crisis. Fortunately, we were well funded. We lent more to New Zealand businesses than every other bank in New Zealand combined through the global financial crisis. So we were there to support our clients. We've just completed a $200 million investment in New Zealand in our store and partner network. We've refurbished over 180 retail stores and built 31 new partner centres like this for our clients to use. And as clients, you feel free to use centres like this right across the country as your office away from home. And we have video conferencing facilities, free Wi-Fi, and it's all free available to our clients. I think the New Zealand banking system is incredibly strong compared to what we've seen that's happened around the world, and we're in the right place at the right time. And I think we're very fortunate to have 2/3 of New Zealand's exports going to countries which are still in growth mode and to the Asia Pacific region. And only 13% of exports actually going into Europe, which is going to be quite challenged for the next 10 or 15 years. And I think we need to make an important statement that as a country, we need to look to the longevity of the country and what's sustainable. And I'm sure Dash will have some views on that. But I think sometimes just being aware of some of the challenges in your business decisions can make you a better business person and therefore better business decisions for New Zealand as a country. I'd just like to pass over to Dr. Oliver Hartwich, who's just going to give an introduction to Dash. Thanks very much.
Well, thank you very much and good evening, ladies and gentlemen. My name is Oliver Hartwich. I'm the Executive Director of the New Zealand Initiative. It's a great pleasure to be here, great pleasure to welcome you all to tonight's event, but let me just begin by thanking BNZ for hosting this together with us. Much appreciated, and we're glad to have you on board and also to have Andrew as one of our new board members. Secondly, of course, we have to thank Das for making the way across the Tasman. Das and I, we both worked in Sydney, although not quite together, but we regularly met in TV studios at SBS and ABC, and we were trying to outdo each other in pessimism and Euro doom and gloom. But he usually won, so I gave up after some time. And I have to thank all of you actually for coming to tonight's event, because as you realize, you had to battle the weather, and you were not even deterred by the title of tonight's talk, the end of prosperity, the end of growth, the end of the Botox economy. I think I mentioned that Das is an optimist. So in a way, we could have held this event basically every single day over the past 5 years, but today might be especially appropriate because we're all waiting what the ECB is going to do at the board meeting tomorrow. We all wait to hear what happens to Spain. We wait to hear what the German Constitutional Court has to say about debt mutualization. So there are interesting things to talk about, and there's probably no one better qualified to talk about all of this than Das, because Das, as many of you know, has been around for more than 30 years in financial services and really dealt on all aspects of banking, of financial services, of derivatives. He has written books about it, Traders, Guns and Money, Extreme Money. He's even an Oscar winner, I think for about 15 seconds or something like that. But he had a leading role in Inside Job, the Oscar-winning documentary, which if you haven't seen it yet, I wholeheartedly recommend. And so tonight he's going to talk a bit about the Botox economy, as he calls it. So basically the end of an old growth model, the growth model that propelled Western economies over the past 30, 40 years, and why he believes, and why I think I agree with him, this is not sustainable and why we need to find a new business model for the Western world. So without further ado, may I hand you over to Das, and welcome Das.
From fields of gold to parched earth. The years of plenty have ended. The improvident find themselves in want in the years of dirt. The GFC was never really over. What happened was we saw a recovery which was driven by government spending and low interest rates. And if you look at that graph behind me, you can see very clearly that most of the developed economies moved their budgets into massive deficit. In this case, that's the UK, that's obviously the United States, and you ran budget deficits of around 8 to 10%. to basically stimulate demand within the economy. And as you can see in the European peripherals, that was taken to extraordinary levels. In the case of Ireland, going off the map altogether, running a budget deficit of 31% in their efforts to obviously bail out their banking system. Parallel to the government expenditure was low interest rates. Having pushed the interest rates down to zero, which pretty much most of the developed world has done, we had to then move on to something different, which is quantitative easing. And people talk a lot about quantitative easing in different ways, but probably a good way to look at it is the size of the balance sheets. If you look at all the major central banks in the world, their total balance sheets were around about 5 trillion, somewhere around that, in 2007. Today, those balance sheets are over 16, on their way to 18 trillion by the end of the year. To put that into perspective, that's 30% of what the global economies produce in a single year. What Karl Marx could never achieve, what the Soviet Union could never achieve, the global financial crisis seems to have actually achieved in terms of socialization of ownership. The United States Federal Reserve balance sheet is about 2.9 trillion today. It'll probably be about 3.5 trillion by the end of the year. The ECB is about 3 trillion. You can name any number as to what it will be depending on the policies implemented between now and the end of the year. Now looking at that in percentage terms, you can see in this graph, the balance sheet in terms of central bank assets as a percentage of GDP is quite extraordinary. And Japan, of course, has been going through these problems for the better part of 15 years. But all the other economies are now paralleling that move. And to illustrate that in a slightly different way, this is the percentages. In Japan, the balance sheet has grown, the central bank balance sheet has grown by 83%. Europe's is by 146. And the interesting one there is the US, which is 223, and the UK, which is 362%. But there is one in the middle, which is an interesting one that you don't normally think about, which we'll come back to. The plan, insofar as anybody had a plan, the plan was to hope for miraculous growth and, of course, a dose of inflation, because nothing fixes problems of debt better than those two. But as you withdraw the stimulus, growth starts to falter. And as you can see, most of the countries in the world are consolidating from a fiscal perspective. Spain, not that number means anything because they won't achieve it, is trying to actually contract by about 7% in terms of the forecast change in government spending. And as you look down the list, most of the major countries which are in battle, like Portugal, Greece, Italy, Ireland, are in that list. And this is not because they have joined Debt Anonymous. It's because the priority is now public sector solvency, not conventional growth. But what amazes me is why anybody thought this would ever work. In 1939, Henry Morgenthau was the Secretary of the Treasury to Franklin Delano Roosevelt. In his private diaries, which were not available for some time afterwards, wrote the following: "We have tried spending money. We are spending more than we have ever spent before, and it does not work." But our political masters, our policymakers, were following a different message, one by the comedian Will Rogers. If stupidity got us into this mess, then why can't it get us out? There are different economic faiths we practice. There is Keynes, there is Friedman, which is basically Irving Fisher via Friedman. Then there's, of course, the Austrians, led by Friedrich Hayek and others, and von Mises. But we're not following any of them. We have our own brand of economics, Botox economics. Now, as you know, Botox is a highly toxic protein which is used in cosmetic procedures. Now, we have a financial equivalent, which is cheap, easy money, usually from the government, funded by government debt or printing money, which we've used. Now, Botox, as we know, does not actually address the core problem. What it does is very nicely cover it up, except Botox has two problems. One, it's temporary, and second, it has side effects. As debt has moved from the private sector to the public sector, the problem has morphed from a financial crisis into a sovereign debt crisis. And Warwick McKibben, the former member of the Reserve Bank Board in Australia, coined the phrase the Sovereign Express, and he talked about gradual derailment. So let's start looking at where all of us have been focused for the last few years, which is the song and dance crisis musical, Grease. Starring, as you know, Oliver Newton-Merkel and John Sarkozy, and you've all been humming, I know, under your breath, the song that the show popularised, hopelessly devoted to the EU. Though, as you know, basically, John Sarkozy has no longer any role in he's retired hurt, and has been replaced by his compatriot Frank Dutchman, who is now playing the lead male role in this particular musical. When the crisis started, we coined the phrase pigs, which was Portugal, Ireland, Greece, and Spain. And it was a nice, catchy sort of phrase. And what we were talking about is this, the debt to GDP. And what is more interesting to me is this number, the absolute quantum of debt. When a crisis occurs, percentages are irrelevant. It's the absolute amount of debt, the quantum of debt you've got to roll over. And I can assure you, $1 trillion is slightly more difficult than 100 billion. That's actually the bottom line. And if you look down that list, we get to somebody who is very topical at the moment, which is Spain. And the thing you notice is not the debt to GDP, you notice the actual amount. The amount's extremely large. But we haven't even begun the list, because I actually coined a different phrase. It was called the FIBs. And the FIBs were France, Italy, Britain, and the States. And as you know, Italy's already beleaguered, but France, Britain, and the United States, both as a percentage of GDP, but in absolute quantum terms, has an enormous quantity of debt. And that's before we get to the other lot, which is the JGBs, which is Japan, Germany, and Belgium. What you're basically going to see is the progressive contamination, the contagion of one economy after the other as the crisis keeps rolling on, and one by one, like a train, gradually derailing, you'll get individual countries have to face their debt of reckoning. How long that'll take is an interesting question. But at the end of the day, thing to remember is we have never in the history of the world had a sovereign debt crisis on this scale. The largest sovereign loss is actually Argentina, as you know, which actually is 82 billion. And if you look at the countries, which is Spain, Greece, Ireland, Italy, and Portugal, the total amount of debt is 4.8 trillion. It's off the scale. And this is the sovereign debt express. And regrettably, I don't think it's going to come to a stop without causing some degree of angst to all of us. So let's look at Europe, because it's topical. Now, Europe's problems have been there forever. And they've been there for at least 3 years that we've focused on it, but nobody really thought about it very much. Until last year, towards the end of the year and last quarter, people drew up the charts of what they had to refinance. And somebody noticed that they had 1.9 trillion in refinancing, which is the European sovereigns had about 1.1 trillion in refinancings to do. And the banks, which are joined at the hip to the sovereigns because of their ownership of sovereign bonds, had another 800 billion to do. Now, this is a one-year snapshot. But the interesting thing is, actually, this is Spain. If you look at Spain, that's 2012, this is 2013, and the amount in 2013 is actually bigger. And as their debt maturity shortens, this problem becomes an ongoing problem. The point I'm making is a very simple one. Even if you get through this year, it's an ongoing problem that you're going to have to manage. And the interesting thing about that is at the tail end of last year, after all the sort of wishful thinking that was going on and equity markets were rallying, the last quarter became very difficult. And Mario Draghi reached for one of his weapons, and he launched the LTRO. And to some extent, I have some sympathy for people like Mario Draghi, because they're basically working within a box, which is the rules and the treaty constraints that they have. And he couldn't finance sovereigns directly, so he came up with the LTRO, the long-term refinancing option, which is actually I call the Lourdes treatment and resuscitation option. And the idea behind that was pretty straightforward. If I can't fund the sovereigns, what I will do is fund the banks, which I'm perfectly able to do, and the banks will then use the money to buy sovereign bonds, which they will repo with me as collateral for the loans I make. And in a single step, I will be able to diffuse the crisis. And in 2 rounds, as you know, they pumped in basically round about $1 trillion. This is the first round, which was 613. I beg your pardon, this was the first round, which was 513 rather, and then later on came another round. The interesting thing is, if you actually look at this part of the bar graph, that's the actual amount of debt that's maturing this year. So if you actually look at the amount that came in 513, then the next thing you look at is why 513 rather than $1 trillion? Well, everybody forgot that the European Central Bank had already lent about 400 billion euros to the banking system. So when you netted that, because that was coming over for rollover, the net new money was only 513. Then the next problem is, okay, well, where did that money go? The 313 in February and the 200. The assumption everybody made was this was all going into sovereign debt. In fact, it wasn't going into sovereign debt at all. About 115 went into what we call the carry trade, also known as the Sarko trade, after Nicolas Sarkozy, who explained this to a journalist. When he explained, the journalist was being particularly pesky, saying to Sarkozy, what did he actually intend to do about this? Sarkozy explained, and I won't do the French accent, but he basically said, look, are you stupid? The ECB is lending to these banks at 1%. They can go and buy Italian or Spanish debt at 5 or 6%, and it makes good business sense to do that. And the Sarko trade was a way of achieving several things. One, to finance the sovereign, ease the liquidity pressure on the banks, and give the banks an earnings stream which would buffer them against the potential losses on their sovereign debt exposures. That was the plot. Except, most of the banks actually didn't use the money to buy sovereigns. Most of the money is actually covering, essentially, their debt maturities for the remainder of the year. And what we've seen in the first half of this year is people have started to focus on this. And this is why the attention turned to, are they going to do a 3rd round of LTRO? Are they going to do a 4th round? How are they going to fix the problem? The basic thing is, substituting debt for debt does not fix the basic problem. The LTRO never addressed the fundamental issues, which is the amount of debt the European sovereigns are carrying. It didn't address the cost of that debt. And as you'll recall, in December, in the period December-January, the yields on Italian and Spanish debt came down. Well, if there is, theoretically, everybody assumes $1 trillion bid in the market for buying that, the yields will come off. But as soon as they decide that that's not there, the yields will go back up, which is exactly what happened. And if you actually look at Spanish and Italian bond yields, particularly at 10 years, they're above where they were in October and November of last year. It does not fix the fundamental problem of banks, which is capital. In fact, also the capital problems come from their excessive ownership of sovereign debt. And there was no attempt to address this. In fact, in a toxic way, we increased their exposure to the sovereigns trying to fix the problem. There was no attempt to fix the funding problems of the banks. The Italian and Spanish banks today have no access to interbank funding. There was no attempt to fix any of these things. And everybody assumed miraculously this was going to work. And you can see this very clearly. At the same time, the European banking system is actually deleveraging. So they're actually reducing their balance sheet size. And this results in the fact that there is no credit growth actually going on. I'll give you one number which is interesting. The European banking system has $300 billion on deposit with the ECB at the moment. Because why? Because basically they receive the money through the LTRO, they're keeping it on deposit to pay back the debt, which they don't believe they'll be able to refinance in conventional ways in markets. So it's actually creating no new credit, and we have a credit shortage in Europe in certain areas. And finally, it doesn't solve the problem, as we talked about before, of the linkages between the banks and the governments. And the amount of government debt owned has actually increased. In fact, you cannot now separate the problem of the sovereign from that of the banks. But that's in the past. What is the magical euro cure? We've all known about that from day one. I remember writing about this in 2009, saying, it's not that difficult. There's 4 things you have to do. What's the first thing? Look, if somebody cannot pay back their loan, we can dance on the head of the pin for as long as we like. In the end, we are going to write it off. And the sooner you write it off, the lower the loss. That is the bitter experience I have learned in my 30 years. The second thing is the banks that are affected, given the quantum of the exposure to the sovereigns, they're going to have to be recapitalized. So you might as well get on with it, let them write it down, and take the money, and basically say, okay, well, here's the money, we'll recapitalize you. Which, by the way, people are very critical of the American response to the crisis. The Americans did very aggressively. And for those of us who have read something of the history of that, you will know that Hank Paulson basically had a debate with the chief executives of banks, where he basically asked them whether or not they were going to take the money, and some said, look, we don't need the money. He said, I don't care whether you need the money, you're going to take it. And everybody knew as well that if they didn't take it, they'd have an IRS inspector and a Fed inspector in their banks for then till the year dot. And it wasn't a very pleasant thought. And you had to do something which is really crucial, which is quarantine the stronger countries, which is the Germanys, the Frances, the Netherlands, and the Finland. Because while those countries had some financial capacity to sustain the rest of Europe, you had some hope. And underlying, of course, was the Lourdes option, which is restoration of economic growth. You had to do all of those. Now, it was always an extraordinarily difficult challenge. But what has compounded it is the fact that the Europeans have A, left it too late, and B, can't even decide what the problem is, let alone come up with a cohesive set of solutions. And by the way, that list was finally acknowledged by the Europeans on the 27th of October 2011, last year, 2 years after the problem started. So what is the European solution? It's a two-track plan. One is austerity and fiscal discipline, which is a way of countries taking their tax revenue, directing it to reducing the debt. All very laudable, all very sensible. And at the same time, liquidity support from a mixture of people, the European Union, the International Monetary Fund, the European Central Bank, the European Financial Stability Fund, which is soon to become the European Stability Mechanism, because they to this day believe that it is a liquidity problem. If you bridge fund these countries, somehow miraculously everything will be all right tomorrow morning. And there is almost a belief in Brussels that if you can come up with more acronyms, you can actually solve the problem. But let's have a look at what this actually has done. And let's put the world into two groups, the peripheries and the core. And by the peripheries, I mean the usual suspects, which is Greece, Ireland, Italy, Spain, and Portugal. This is what's happened in Greece. Firstly, unemployment has increased, which is not surprising. If the government practices austerity at this level, the withdrawal in demand, already an economy in recession, does not improve the demand outlook, and the economy starts to contract. As the economy starts to contract, your budget deficit actually goes up, not down, because your tax revenues actually start to fall, and because of social welfare payments and the automatic stabilizer of the economy, your expenditure starts to go up. And you can see this very, very clearly in the growth of debt. And in fact, as you can see, the economy starts to shrink. This is not rocket science. This is economics on the back of an envelope, which is usually the best form of economics that I have learned over the years. As Tyler Cohen put this, it's a moot point whether Greece is a poor country masquerading as a wealthy country or vice versa. If the old illusion was that Greece was a wealthy country, the new illusion is that Greece will in short order become wealthy enough to pay back ever-growing sums of debt. And this does not even begin to factor in that the ordinary person in Greece is basically being decimated and is expected to lie back and think of England and basically enjoy this entire process. But in my view, the story about the peripherals is all over. They're gone. The only argument we have is what is the extent of the write-offs of these countries. That's the only argument we can have at the moment. The real problem is, it's like gas gangrene. When you get gas gangrene, which is a horrible disease, initially what they do is give you some very powerful antibiotics and put you in a hyperbaric chamber because high dosages of oxygen kills it. If that doesn't work, you amputate it. You have to. There's no choice. Otherwise, the whole body gets poisoned. And it's like having an infection of your toe. If you cut off the toe, it's fine. But once it spreads to your major organs, like your heart, your liver, your lungs, your blood, your brain, your spinal fluid, it becomes very difficult to treat. And Europe dilly-dallied for for a long period of time where the problem is no longer a problem of the peripherals, it is a problem of the core. And this can be seen very clearly because apparently Germany is going to save Europe. Let's leave aside all the emotions and basically ask ourselves about the numbers. The first thing is German GDP is around 3.6 trillion US dollars. The debt to GDP is 81%, which by the way is higher than Spain's. Now, the next thing is how much private assets do the ultimate savers in the economy have? And Der Spiegel actually published an interesting table where they looked at the bank assets and reserves of the average German and totaled them out. And it was 4.7 trillion. Now, well, that's, I suppose, the resources available. You know, I like to do funds, use of fund statements. So what is the use of funds? So how much is Germany on the hook for? The first thing is, German banks, by the way, are on the hook for somewhere between 400 and 500 billion US dollars to the rest of Europe. Germany itself has just a 211 billion guarantee to the EFSF, the European Financial Stability Fund. And this is the loans that are going into Greece, Ireland, Portugal, etc. But that's not the real issue. The real issue is an arcane piece of engineering, which is the Target 2 system. Which is basically, because you don't have full monetary union and full fiscal union, full political union, you've got to have a way for the central banks to balance the books. And the Target 2 system balance that Germany has is now over 700. I think it's 771 the last time I looked. But let's have a look at what happened. And you notice in that graph, until about 2008, the balances in Target are actually very small. Not because the balances between countries are small. In fact, Italy, not so much Italy, but Spain and Greece certainly were running large current account deficits. But they were being funded by commercial sources, by banks and so forth, so central banks didn't have to fund each other. In 2008, as the crisis starts to start, and particularly around here as it starts to accelerate, what happens is those countries are still running their current account deficits. They have to be funded somewhere. They can't be funded commercially. So the other central banks have to start to fund them. And if you actually look at that, you can see over here, Germany, Netherlands, and Luxembourg, which are the major funders, and of which Germany is by far the most significant, funding the current account deficits of Belgium, France, Greece, Ireland, Italy, Portugal, and Spain. And that is going to only accelerate. And this is actually another graph of the same thing. This is the actual balances, and this is the growing German position in the target settlement system. But let's look at why that's going to accelerate. And you can see this from this third graph. Look at the light blue. That's actually Italian and Spanish balance of payments, and the light blue is foreign investment. Let me put it in a more polite way. It's flight capital out of Spain and Italy. Why? Because why would you keep your money in an Italian and Spanish bank knowing full well, number one, there's default risk on the bank, but most importantly, there is redenomination risk in the sense that if they have to leave the euro, you're going to end up losing a substantial part of your savings. So if you have the wherewithal and the means and large enough, what you do is take the money out. And you can see this in balances in the UK, you can see this in balances in Switzerland, and until recently, until the Bank of Cyprus, the banks in Cyprus rather had problems in Cyprus. That's where the money was going. Now the point here is, okay, well this amount that Germany's lent, is any of it coming back? Well, generally, taking on other people's bad loans isn't a good banking practice that I have seen. Certainly not when you're taking it on at full face value. And the view of everybody now is very clearly to the point that every amount that's been lent, there's going to be losses. So let's actually look at what Greece alone would do. This is what Greece owes at the moment. It owes 134 to the ECB through bond purchases. And let me just digress for a second there. I haven't even talked about about just under $1 trillion euros, which the ECB is out to these countries, either through direct bond purchases or by financing the banks in those countries against such excellent collateral like Spanish government debt, Italian government debt, Greek government debt, though they don't take that as collateral anymore. And what is the ECB's capitalization? Balance sheet's it's around 3 trillion. They've got 10 billion euros in capital, going up to 20 very gradually over the next few years. Now, central banks theoretically can't go bankrupt because they can print money. But basically, they will need at some stage to be recapitalized if they take losses on this. So if you actually look at the balance sheet side of the ECB, it's got basically bad loans. That's basically what it has. And to give you some idea of the effect on individual central banks, let's just digress for a second and talk about the Bundesbank balance sheet. Before the crisis, the Bundesbank balance sheet was pristine. It owned high-quality government securities, had some gold, had some cash. Today, their balance sheet looks quite different. Their assets, their securities are down to 20 billion. I think the last time I looked around about that. They still have 150 billion in gold. And the most interesting thing is the major asset they have is loans to the target system and through other means to other central banks. And on the liability side is the most intriguing part. They've had to borrow money from their own banks to finance this, which is a highly unusual thing for a central bank, because generally you have an asset to the banks. So how much is Germany going to lose? Well, you can take any number. If you actually look at that, Greece also owes 113 billion in to the bailout funds, 22 billion to the IMF, which I actually no longer call the IMF. Since Christian Lagarde got there, I call it influential moneyed friends, because you can just go and say, Christine, you're good for another 20, aren't you here? 55 billion to foreign investors in bonds, and 100 billion in foreign banks. And I'm not the only one who, by the way, thinks that Mr. Cohen, one of the economists who left recently, wrote a letter of protest to the IMF staff board, basically saying that he thought that he regretted ever working for the IMF, and had spent 20 years which he deeply regretted, and he found the entire system of the IMF to be so deeply flawed, and its selection process of its chief executives and entire process to be deeply troubling. So how much is Germany going to lose? Well, you can pick any number for Greece. Between 30 and 80 is a very common number that's used, 30 billion euros. But if you look at all the peripherals, how much are they going to lose? The estimates run, according to the IFO, which is a German think tank, from between 800 billion to 1.4 trillion euros. You're talking about anything up to 40% of German GDP being written off. The best way to think about Germany is to think about if you go climbing. If you climb your rope up, you tie yourselves together, so if anybody slips, you can haul them in. The problem is if too many of you fall off. All mountaineers rope up, they also have a very sharp knife. And the skill is in knowing when to wield the knife unless you're particularly self-sacrificing. And my fear is that Germany and the stronger countries in Europe have passed the point of no return. And this doesn't even address the real issue, which is things like growth. How do you fix growth when this is the cost structure of countries like Greece, Italy, Spain, and Ireland relative to Germany? There's a 30% discrepancy. And in the old days, I used to trade lira. Okay, I used to trade lira, and I know how lira trading worked. Every once in a while, they drop 3 zeros off it. They managed the economies by devaluing it and having high interest rates. That was basically the strategy. Everybody knew how that happened. The skill was being long lira until you thought this was going to happen, in which case you went hellishly short. You were either hellishly long or hellishly short, never anywhere in between. It didn't make any sense. But you can't now do that. And the reason you can't do that is pretty straightforward. Because essentially you have a single currency, but implicit within that is highly overvalued currencies, which is countries like Spain, Ireland, and Portugal, who would benefit from a devaluation, which of course the euro does not give them. And you have here Germany, which is almost essentially now trapped because it benefits from a cheap euro in terms of its own exports. So if the euro breaks down, they suffer not only on the loans that they've made, they suffer through a revaluation of their replacement currency or a core euro group and lose export competitiveness in terms of relative to the US dollar. And the real economy. How can somebody explain to me how an economy like Spain can survive 25% unemployment on average and 50% youth unemployment in a social sense and hold the country together? It's quite unbelievable. There's a young woman who gave an interview to the New York Times. She had 4 degrees, spoke at least 3 more languages than I do. And she very ruefully remarked that she had every certificate except a death certificate. And we're now starting to see this in the growth figures, where the PMIs have turned down, the Purchasing Manager Index, GDP growth has turned down. But the interesting one to look at here is the core versus the periphery. Germany and France are the blue and the red. This is the rest of Eurozone. You notice that Germany and France are being dragged down along with the rest of it. And the answer is, it was always going to be so. Why? Where does German exports go? Who are their two major trading partners? Happens to be Spain and Italy. And if they're in recession, how can Germany be exempt from the effects of this? Everybody says, but they can export to China. China is 5% of total German exports. But never fear, the Troika is here. For light relief, I want to share with you, this is their forecast for Greece. This is where Greece growth is, and this is how they will recover. If this actually occurs, Greece will be renamed Lazarus. But having given up on economics, the Europeans are interested in linguistic. As Elena Salgado said, Spain is not Greece. As George Papandreou said, Greece is not Ireland. Angela Gurria, who's Secretary General there, said that neither Spain nor Portugal is Ireland. Mariana Rajoy said, Spain is not Uganda. And even the rating agencies got involved in the debate and said, Italy is not Spain. So what's the plan? Well, the plan is pretty much always the plan it has been. They're going to implement the December Treaty, no matter what happens. Why? At least they've agreed on something. Which means all the European stability pacts, etc., and the contraction, and bringing the debt down to the levels that they've agreed. They're going to continue with the existing bailout packages, which will need more money, because Greece will need a third round. There's no doubt about it. The question is whether Ireland or Portugal will do. By the way, Ireland issued a successful bond the other day, which was kind of interesting. The pity the Irish banks, the English banks, and all the other banks in Europe bought them and then repoed them with the ECB. Other than that, it was a hugely successful issue, I thought. But both these countries have to go to real capital markets next year, because that's according to the IMF and the actual bailout plan. They have to access commercial funding next year, 2013. And the banks have to be recapitalized. The Spanish bank number of 100 billion is a joke. They will need 3 times that at a minimum. Oh, by the way, there is no plan B. Let's have a look at the firewall, the famous EFSF, the ESM, and the IMF. Total is about 500 billion. They've already committed 294. If you look at the EFSF, if they take the bonds that the ECB are holding, which basically the ECB is desperately keen to shift on to somebody else other than themselves, well, that's another 211, and they've already committed 100 billion. By my calculation, I can't add or subtract very well. After all, I used to be a derivatives trader. So basically, under those circumstances, I can't see how much is left over. And the most important thing is, since about June, July last year, not a single new euro has come out of any European summit. There's been lots of nice words, but nobody has put any new money on the table. And how much money could they need? Well, let's have a look at the debt maturities. This is Spain. Just to the end of 2014, they need 154. I left off 2015 because they got some very chunky maturities then. And this is Italy. They need another 402. You've got to stop the capital flight. How do you do it? You have to insure the deposits. It's very straightforward. Ireland tried that. That was a great success. This is the total deposit in the euro system. It's 7.6 trillion, of which roughly, say about 6 trillion is retail, which is the vulnerable bit which moves. Peripheral countries have about 1.8 trillion of that, so a credible insurance scheme is going to be euro 1.3 trillion. Who's going to put their balance sheet on the line to do this? I and others said from day one, if you're going to have a bailout fund, you need about 3 to 4 trillion euros. And if you don't have that, cut the Gordian knot, decide now, we don't have this money, and get on with life. Because you can't do it half-heartedly. And the Europeans have found new ways to juggle the 500 billion in ways which are mind-numbing. The new plot, is that the European Stability Mechanism will get a banking license, and therefore be able to leverage themselves up. And I'm sitting there, okay, Let me work through this. So they're going to have 80 billion in permanent capital. Where's that going to come from? Spain, Italy, Portugal, Ireland, Germany. Where's Spain and Italy going to get the money from? Oh, they're going to borrow it. Right. From whom? The ECB. Right. Okay. Got that. Where's the 420 billion that we haven't covered yet? Oh, they'll borrow that. Right. Who from? Haven't figured that one out yet, but with 80 billion in capital, we'll be able to do that. And then we'll leverage it up, say 8 times. We'll have our 4 trillion. You ask for 4 trillion, I'll give you 4 trillion. And who's going to lend the 3.5 trillion? You cannot get, as a famous Australian treasurer, Paul Keating, once said, quarts out of pint pots. And that is the problem that the Europeans actually have now. And while all this is going on, of course, the real economies are imploding, real house prices are coming down, unemployment's going up, and government debt continues to rise. But we have Angela Merkel and Francois Hollande, the end of the euro, it is unsinkable. By the way, you think Europe's bad? I think Ken started by talking about the United States. I've got some interesting news for you. That's the biggest show in town. They're broke. Not to put too fine a point on it. Let me show you the CBO. The CBO stands for Congressional Budget Office. They do forecasts. They're hilarious. They're the best comedy I can ever think of. This is their forecast, straight off their forecast. Notice that their budget deficit is going to shrink. It's not going to go into surplus, but it's going to shrink. That's the light blue. And I looked at that and thought, this is interesting. What's this? The alternative fiscal scenario. So I read through the thing, and the alternative fiscal scenario is, oh, if the Bush era tax cuts don't expire and are rolled over, oh, if payroll tax cuts are continued, and there's a list of about 7 items, all of which will be continued, because the US economy is going to be weak at the relevant time, which is the end of the year, and it's unlikely whoever gets into the actual White House is going to have majority in both houses of Congress to be able to pass any legislation. Though in the United States, it doesn't matter if you have a majority. Obama had a majority very briefly for 2 years, and he couldn't pass anything anyway, even with his own party. So basically, I don't think you can ever really hope for anything. Oh, and by the way, they're assuming 4 to 5% growth through the entire period to get to these numbers. I rang up somebody I know who used to work at the Congressional Budget Office. I said, I've got this spreadsheet. I can't get to 4 and 5% growth under any circumstances. He said, you're doing the spreadsheet wrong. I said, what do you mean I'm doing it wrong? He said, you start with the budget deficit figure and solve for the growth rate. You need to get to that. You don't start from the growth rate and go, you've got it the wrong way around. I said, oh, well, that makes perfectly good sense. Because I can't get to the number. He said, you never will. This is the horror story of debt. Have a look around here. This is US debt to GDP. It just goes vertical. And that is round about the time the crisis starts. And you can't correct it. And let me explain why. This is the untouchables on the US fiscal agenda. You can't touch entitlement agreements, which is basically Medicare, Medicaid, Social Security, which is 44% of your budget. Why not? You lose Florida and all of the Sunshine States, so you're never going to get elected. You can't touch defense, which is 24%, because the Americans fear an invasion by the Canadians, an invasion populated by niceness. And they need an armory of drones and cruise missiles to protect themselves from this niceness attack that's going to come. You could renege on this 7%, but does have serious consequences because you're contractually obliged to pay that. That leaves 25% of your non-defense discretionary to play with. That's all they ever play with. So how are you going to actually correct your budget under those circumstances? I have no idea. And Ken, this one's for you. This is all the off-balance sheet stuff that there is. Medicaid, 35.3 trillion unfunded. Medicare, 22.8 unfunded. Social Security, 7.9 trillion unfunded. Actually, I don't take any notice of this. It's never going to be paid. If there's no money, this is all never, never stuff. This is the politician's dream. Push every liability into the future, bring all your revenues to today, because when it gets there, I'm not going to be here, and if there's no money in the till, it's not going to be paid. It's as simple as that. From mid-2009 to end 2011, the deficit has increased by 3.3 trillion. GDP during the same period has grown by 1.47. Think of a company whose actual revenues are increasing by half the amount of debt every year. And think about whether you would lend to them. $2 out of every $10 that go into American wallets are jobless benefits, food stamps, social security, and disabilities. There is 40 million people in the United States, roughly about 10% of the population, now on food stamps. In other words, they need help to feed themselves. In the past 3 years, US public debt has exploded by 5 trillion, which is over 1/3 of the total amount. Now, it took them over 200 years to get the first 10, so obviously it was a case of rinse and repeat, and they've got the formula down pat, because they can do it much more quickly now. For every dollar of tax revenue they raise, they spend $1.60. And this is the problem. Federal revenue is 15% down from the peak of 18 to 19, and even the 18 to 19 was artificially inflated by capital gains tax benefits during the late 90s and early 2000s. And the comparatives in terms of tax to GDP is much, much higher. So you can't do this without actually increasing taxes in some shape or form. And the problem is, apparently, one of the American Constitution or commandments is thou shalt not tax anybody. 45% of households do not pay tax because they don't earn enough or have credits and deduction. And 3% of taxpayers contribute 52% of tax revenue. I'm highly critical of Obamacare. Not for the reasons you might think. I would have taken that healthcare budget and directed the entire amount to this 3% to make sure they live forever. And in fact, I would have directed my entire budget to cloning these people. Because that is the only hope America, from a fiscal or a public finance point of view, has. But look, these numbers are mind-numbing, so let's get it down. Let's get rid of 8 zeros. And think of your family budgets. And I know the United States is not a family because you can print money. Annual family income is $22,000. Money the family spent, $38,000. Shortfall, somewhere between $16,000 and $17,000. And you've already got $143,000 on your credit card. And last year they cut the budget by $385. According to that, it would take them 423 and a bit years to pay back that debt. And even with the mandatory budget cuts, which have come in as a result of the raising of the debt ceiling, which is $12,000 over 10 years, it would still, assuming you run a balanced budget, take you over 12 years to get your debt down. I hope that clarifies it. But China is going to save us, isn't it? So what is driving Mr. China? I think you got to differentiate 2 periods of history. Pre-2007, 2008, post. Before that, as you'll see from the numbers, it was export-driven. In 2007, 2008, the Politburo needed diapers in China. And the reason was pretty simple. There were 20 million people unemployed in Guangzhou alone. And the Chinese Communist Party basically prized social stability more than anything else. And they could see a massive threat to social stability. So they borrowed something from the American rule book. So they pumped massive amount of government spending into the economy, except they did it differently. Their budget did go into deficit, it was a relatively small one, but they don't need to run budget deficits because they control the 4 main policy banks. So what they did was direct them to lend. And have a look at this inflection point in 2008. At this point, the Chinese banking system strapped on Saturn V rockets to their loan books and fired them. I have never in my life seen a bank balance sheet collectively of an economy do this. And this is the amount you're talking about. 42% of GDP in 2009 and 2010, 37% in 2011. By the way, they were trying to rein in the lending during that period. And currently it's running at between 70 and 100 billion a month. And the total stimulus, if you look at it, is roughly about 15% of GDP every year. And that's the official number, by the way. The blue line is the unofficial stuff, what is known in Chinese terms as curb lending. And if you look at that, again, you see a massive explosion in credit. Now the question is, so what? Well, the question is, where did the money go? But before we look at that, an eerie parallel. This is the United States from 2002, explosion in credit. This is South Korea, 94 to 97, and that ended well, as you know. Explosion in credit. This is Japan, 1985 to 1990, explosion in credit. And this is China. 2007, 2008 to 2012. And by the way, China is by no means the worst of the emerging market complex. If you take domestic credit as stock of GDP, you notice there are worse offenders in the emerging market complex. Australians don't care. They say, we don't care what they did, as long as they keep buying iron ore. Doesn't really matter, does it? And to some extent, that's always true. Where did the money go? The Chinese have a very simple economic model. It's investment driven. And the role of investment versus consumption is the important thing to appreciate about China. And the best way to understand that is during the period, if I take 2000 to 2010, that decade, as you can see, investment went up to over 55% of the economy, which is from 37 at the start of the year. So roughly a 50% increase in the investment component. During that period, obviously savings also went up, as you can see, from 35 to 43. I'm not much of an economist, but as I understood it, savings and consumption are mutually exclusive. So let's see what actually was going on. You notice the large red, which is actually exports, net exports. It was driving the economy pretty consistently. They had a few down years, but overall it was a major contributor. But during this entire period, investment is the major contributor. And you can see this very clearly. Private consumption, which is actually China is the red, is very low. This is South Korea and Japan on top. And these countries are not exactly spendthrift by any stretch of the imagination, but they are about 10 percentage points, 20 percentage points of GDP higher. But this is the one that is actually telltale. Most economists say once you get to $1,000 per capita income, you sort of reach some sort of economic takeoff point. So if you actually look at what South Korea and Japan did, you notice that investment as a portion of GDP stabilizes around 30%. China's continues to rise, and the gap is about 15%. So why investment? It's very simple. The Chinese Communist Party are control freaks. How do you control your economy? You control it by basically getting state-owned banks to lend to state-owned enterprises because you have control. It's all in Beijing. And you control the economy that way. You can see it. Because they don't actually trust it. A Chinese Politburo official admitted to me for every renminbi they sent to the hinterland, they lost about a third. I said, sorry, what do you mean lost? He said, lost. And I, being thick, said, you mean somebody stole it? He said, no, it was lost. So they didn't like actually a decentralized model. It's not very typical of them. So they actually found this is the easiest way to control it. But the question is, okay, so they overinvested. They've overinvested before. Surely it can't be all bad. And every China lover comes up with, well, they don't have infrastructure, so they need more infrastructure. There is this massive population, which I refer to as the 2 billion armpits theory. If there's 2 billion people with armpits, surely there's a big market for deodorant. So there's a lot of people, so they must need this infrastructure. The point is, where did it go? This is the city of Ordos in northern China. It's completely empty. It costs 40 million a year to keep it empty. Because, even if a city is empty, as some of us will remember the Yes Minister episode, just because a hospital doesn't have anybody in it doesn't mean there's a huge expense in running it. My proposal, I wrote a letter to Gordon Brown in 2009, saying that he would avoid a lot of angst if he basically, when did he lose power? It would be 2008. That he would basically be better off actually essentially buying this city, renaming it London to hold the Olympics there, because it'd be a lot cheaper than what his cost base would look like. I never got a response, strangely. So it's gone into these sorts of things, and you can see these shots anywhere you want to of empty shopping malls. Okay? So these are just wasted investments. And this term we now use is called malinvestment. Is this bad? They might grow into it, I don't know. But the problem is, it's going to be very low returning investments. Lower than the cost of capital on the other side, And I think of a country as an investment project with a series of assets on the asset side of its balance sheet. And if they don't produce high returns, how the hell are you going to grow? But the second thing they did, and which is much more interesting, is their excess capacity in cement is now greater than the total consumption of US, Japan, and India. Their excess production in steel is greater than the total production of Japan and South Korea. So there's massive overcapacity in a world which already has overcapacity. That's the biggest problem. And if they start to dump that capacity, well, it has implications elsewhere as well. And the other thing is this credit bubble has created huge pricing anomalies. Let's have a look at the property prices in a second. But just before that, there's 60 million empty apartments, 15% of total apartments in China, and there's a whole bunch of reasons for that, it's empty. But what about prices? The cost of a central Beijing 100 meter squared apartment, last time I looked, was renminbi 3 million, which is 450,000. I tried to work out how long you'd have to work to earn one of these. So if you're a peasant farmer in China today, you would have had to start work during the Tang dynasty, which, if you're not up on Chinese, is 907 AD. If you're a Chinese blue-collar worker today, you earn about $225 a month, so you would have had the luxury of starting a little bit later. Around the mid-19th century, during the Opium Wars, it would be pretty good. Prostitutes have to entertain 10,000 customers, and a thief would need 2,500 robberies. People are highly critical of Chinese statistics, but nowhere in the world have I seen statistics which enable me to calculate that. So how's China going to correct this? It's very simple. They're going to correct it the way they always correct it, which is they're going to rob the savers to bail out their entire financial system. So what will happen is they will pay their depositors about 5% less than the actual inflation rate. The money will be trapped in the banking system, and a liquid banking system can just stretch out this problem forever. And if you have a net subsidy of around about 5% going from the savers to the borrowers, you can continue with this problem forever. How do I know this? This is what's happened every other time. I can point to a number of vehicles in China called asset management companies, including my favorite. It's called Hurong, which stands for Divine Wind, because that's about all that's in it. Basically, essentially, what you've got is all these bad debts that they bought from the banks. Then what they did was issue bonds, which are guaranteed by the government, bought by the same banks that sold them the loans. And it's still sitting there. I helped roll them over 2 years ago because I helped set up the original vehicle 5 years before that. So I helped roll it over. Nothing has been resolved. I said, has any of these loans been resolved? He said, don't be ridiculous. They're there. There's a nice investment for the bank. So basically, we just keep running the whole game over and over again. That's what's going to happen. So what's China's future? I understand from reading all the economists in the world, it's growing at 8 to 9%. Is that important? Oh, yes. That is the rich economies. That is the BRICS and other emerging economies. In other words, China and the BRICS are contributing most of the growth. Except, are they growing? Let me pose a little dilemma for you. They're growing at 9%, but the driver of growth is directed lending of 30 to 40% of GDP. The Chinese regulator actually admits their bad loans are going to be between 25 and 40% of what they've lent. This is the Chinese regulator. So that's going to come to about what, 8 to 16% of GDP? Now, my understanding is when I do a bank balance sheet, I take the net interest income, but I take off the bad debts. So if I take off these bad debts from this number, the question I'd leave you with is China growing? So every time I pose this question, everybody goes, Das, you're just too pessimistic. Look at China's capacity for further stimulus. That's where you've got to look. I go, okay, fine. I'll go and do a bit more research on that. I think China's all stimulus out. Firstly, let's look at the external account, trade. The trade surplus has gone from 250 billion to 150 billion, and their reserves, which is a good sign of the surplus coming in, are stabilizing. And part of it's because 180 billion gets taken out of China in capital flight every year. As I said to somebody, I'd be happy to invest in China once the Chinese themselves started to keep money in China. Why is this occurring? Have a look. The blue line is imports, and the imports have gone up because they're energy and commodity importers. On the other side, the red line is basically the exports. And their two biggest trading partners are, you guessed it, Europe and the United States. Well, that's not going to work. Then they go, that's just showing the current account deficit, a surplus rather. Then they go, okay, well they can surely take on debt. They don't have much debt. Really? The official figure is 17%, but if you add the local government debt, which basically the central banks govern, policy banks 13%, Ministry of Railways, which by the way employs 2 million people, has 5% in debt, and the asset management companies, which is the old bad debts I was talking about, is another 4%, non-performing loans are another 65%, the debt to GDP is about 60%. Not as bad as the United States, but not low either. And most emerging markets have what I call an inverted debt structure, which is a term coined by Michael Pettis, which is, inverted debt structure means what happens during crises, emerging market debt explodes upwards very quickly. So that's not going to work, which goes to the last one. They go, look at their savings and FX reserves. They got these 3.2 trillion. And if you look at global reserves, China is by far the biggest single number of that. What could you buy with 3.2 trillion? Well, the answer is a heck of a lot. The Economist had a moment of sort of a wet dream, really. They did a fantasy shopping list. They thought you could buy all of this year's oil output, you could buy all of US farmland, buy Apple, Microsoft, IBM, and Google, you could buy all of Manhattan, all the sports teams so you could watch something in your spare time, and still have money left over for a good time. Except, the reserves are worth zip. Why? What are they invested in? US Treasuries, US dollars. Wonderful bonds from Germany, from France, from Italy, from Spain, and euros. And Japanese government bonds, JGBs, and yen. Why do I say they're useless? Somebody said, are you suggesting US Treasuries are useless? I'm saying I'm not suggesting US Treasuries are useless. I'm just suggesting China can never monetize its holdings. Because the moment it tried to sell it, the US dollar would collapse and the value of their securities would collapse. And in their more candid and lucid moments, the Chinese admit to me that in their mind they've already written this amount off, because it's never going to come back. It's a question of managing that, because they know what's going to happen. These countries will pay the minuscule interest rates and devalue their currencies against the renminbi and wipe them out. In a battle between creditors and debtors, the debtor always wins if you're a large enough debtor. In anti-personnel warfare, in case you're not familiar with this, there are two types of mines. One is a contact mine, you step on it, you go boom, goodbye. But the nice one is a bounding mine. You step on it, nothing happens. You step off it, it jumps off the ground, explodes, and shreds a lower part of your body, because to the enemy, a wounded soldier is worth much more than a dead soldier, because it ties up more resources in looking after it. Because we like to be humane in war, which is a contradiction in terms anyway. China has stepped on the world's largest bounding mine. It's called US Treasuries and the US dollar. And they're still trying to figure out how to get off it. And you can see this very, very clearly if you look at combined monthly activity and real GDP and PMI manufacturing, they're slowing. Everybody says, well, they're going to slow to 5%, but it's going to take a long time. Let me give you a pertinent statistic. Japan grew at 10% during the 60s, 5% during the 70s, 4% during the 1980s. In my experience, when the growth peels off, it peels off quite quickly. And the real growth figures, I'm not really sure what the real growth figures are anyway. Basically, if you look at industrial production and energy production, which are closely correlated, notice that energy production is falling much more quickly, and everybody rationalizes that by saying they become more efficient. They might have, I don't know. But I always look for soft factors to determine this, and the soft factor I look at is hubris. This is the Chinese People's Daily, which is the mouthpiece of the Chinese Communist Party. High-level figures from Western political and economic spheres envy China's superb performance, as well as China's spirit, the kind of solid, unbreakable Great Wall at heart to ward off the financial crisis. Every time I read a statement like that from a bank chief executive, or a chief financial officer, I short the stock. But the good thing is, even if they stop growing, we'll never know, will we? And ignorance is sometimes bliss. So how is this all going to end? What's the outcomes? We could end up in La Belle Epoque, A spaceship could arrive from Mars. Little aliens could get out. They could give trillions of euros, dollars, and yen to the denizens of the happy blue planet who could pay off their debts and be happy ever after. We could have collapse. The dominoes that we've outlined could fall one after the other. Or we could have stagnation, which means we could turn Japanese. And we could all sing the song from the Vapors, I'm turning Japanese, I'm turning Japanese. I really think so. For those of you who've now done me as a doomster, though I used to be a bankster, so it's probably one step up from being a bankster, so it's not too bad. Let me give you the odds. Stagnation, 75%. Collapse, 20%. Mainly because policymakers somewhere will press a wrong button at some point in time, you know that. And I give that 5% chance. I scan the night skies every night. There might be something out there, you know. But what does turning Japanese really mean? This is what it is to look Japanese in the economy. Nominal GDP is the same as 17 years ago. Number of employed people is the same as 20 years ago. This is real wages, down about 16% from peak. And I picked two areas of relevance to consumption-driven societies. One is retail sales. As you see, it grows a bit, it flatlines. You basically get into a world where people buy the need-to-haves existing as nice-to-haves. And I picked one durable, cars. By the way, Japanese cars are very interesting because most people in Japan don't like owning old cars. Cars in Japan used to be sent to Russia in the old communist era because they were relatively brand new. This is car sales in Japan. Peaks at about 8 million units. And it's now hovering around 4 to 5. In other words, what I'm saying on durables, it moves to replacement. That's actually what happens. It's not the end of the world. The world doesn't end. It just changes the way it behaves. And by the way, did I say we were turning Japanese? Perhaps we already have, and we don't know. Let me share with you a couple of stats from the United States of America. This is, as you can see, real retail and food services sales, essentials of life. This is where they are now. This is the peak. In fact, these unit sales have not actually reached the levels of 2008. During this period, population has grown by 3%. So per capita consumption has come down. I understand there's a recovery in the US housing market. These are housing starts. I have been saying to economists, don't look at growth rates. It's meaningless in this sort of environment, but they insist on looking at growth rates. The average is about 1.5 to 2 million units, say 1.5, so you're running at about a third. But I understand this is the new definition of a recovery. This is actually employment. I understand the employment in the United States is picking up. Total employment is now 140 versus 146 at peak, and population has gone up 3%. If you do the U6 number, which is number unemployed, plus the number in part-time work seeking full-time employment, plus you adjust for the participation rate, real unemployment in the States is somewhere around 15 to 18%. Income levels. The red is using the CPI. Income levels are below 1972 by roughly about 10 to 12%. If you do the CPI number slightly differently using different bases, because they rebased the CPI in the early 90s, it's probably much lower. And the real test, GDP. GDP in the United States has actually passed the level of 2008, but it did so very recently. So we're already halfway into a lost decade anyway. And if you look at the GDP growth of the G7, it's gradually been coming down from around about the 3 to 4% on average, using the weighted average of these countries, down to about 1%. And the economists, bless their hearts and souls, constructed an index which was irrelevant but amusing. It included GDP, consumption, stock markets, wages, house prices, wealth and unemployment, all natural coincidental figures into an index to measure how far back countries had gone. Greece was now back at 2000, which is a small step back to the Dark Ages and probably to prehistoric times. Italy, as you can see down the bottom there, is well on its way, but almost every country on that list, including Germany and the United States, has gone backwards during that period. I think Mervyn King got this absolutely right. It's the levels, stupid. It's not the growth rate. It's the levels that matter here. And those levels have not recovered. I have only one question. Why now? Why not after I'm dead? There was the real economy. We financialized it. We added a bit of debt and a bit of speculation, and we had this thing which was a big economy. And now we have the global financial crisis, the global sovereign crisis. To come is the global commodity crisis, followed by the global emerging market crisis, and there's always the ongoing banking crisis, which will go on through this. Somebody somewhere in the universe who doesn't like us has pressed the reset button, and we're on our way back to the real economy. But this deleveraging is very hard. And let me just share with you a simple statistic of how growth is not a normal state. Between 1500 and 1820, the world exploded by 1.7% per century. Between 1820 and 1900, industrial production increased by doubling, 100%. And between 1901 and 2000, it increased by 4 times. Growth in nature is something which at a point ends. It doesn't keep going forever. It's a sign of immaturity if we believe that growth will continue forever. So let's talk about some absolute truths. Deleveraging has barely started. The process of reduction debt has barely started because the governments took the debt on their balance sheets. Deleveraging will take a long, long time. Consequence of deleveraging in terms of demand contraction will be unprecedented in the history of modern economic times. Risk will not be rewarded. Volatility will be extreme. There is no magic bullet. Only the Lone Ranger and Tonto had one of those. Don't read your economics test, read Alice in Wonderland. A slow sort of country. Now here you see it takes all the running you can do to keep in the same place. If you want to get somewhere else, you must run at least twice as fast as that. The Red Queen's advice is a good one for these times. Let me show you how hard deleveraging is. This is Japan. When the bubble burst in 1989, it's 270%. Even today, it's higher than that as a percentage of GDP, mainly because GDP is static. But notice it peaks roughly 9 years after the bubble bursts. And what we see is basically private debt come down and public debt expand gradually over that time. What happens is the Japanese central bank steps in,